Welcome to Trends with Benefits, an award-winning podcast by Van Eck with a forward-looking perspective. We explore new ways of thinking about the markets, work, and life. Here's your host, Ed Lopez.
I can't believe it's been 4 years since the last time we did this.
Has it been 4?
I think so, yeah. I think we did it last election cycle.
Maybe there's something to that cycle.
Maybe. But, I'd like to see it more than four years at a time.
I'm game.
Is this year different than others? I mean, just in terms of activity and data coming out and analysis, or is every year kind of has its own unique kind of pace to it?
It's unique. I mean, we had a rematch for presidency for a while. That was pretty unique. That's happened once before, 100 some odd years ago. Then we had the sitting president drop out, which LBJ did. So there's been some uniqueness. There's also been some similarities. We've got, strong performance, early year performance, some definite election year forces influencing the market. We're seeing some vol here in September, probably get some more in October. So that's very typical. So, I mean, that's kind of what we do with the Almanac is take the usual stuff, the repetitive stuff, the cyclical stuff, the seasonal stuff, and overlay with what's going on the ground. That's not regular, whether it's this particular election setup with the two guys running, rematch, or whether it's AI or the Fed, so it's not just follow the exact pattern because the patterns are averages and it's never exactly the same, but it's a pretty typical election year, all things considered.
Yeah. I'm speaking with Jeff Hirsch. He's the editor-in-chief at the Stock Traders Almanac. And as maybe you heard, he's joined me once before the last election cycle. And lucky to have him again this time around. And this is September 2024. This is one of my favorite things to talk about and to look backwards to see where we might be going in the future. Again, Jeff, welcome and thank you for joining me again.
Always good to be with you, Ed. I think last time was kind of unique too. We had COVID.
Oh yeah, that's right.
That was new.
Yeah. There's always something to work around and there's something to work through. And, you got to look at history sometimes, right? To kind of have a sense of how to adapt and address what's in front of you.
So history is interesting. I find it interesting. My senior in high school their summer reading was Fahrenheit 451. So I decided to read it. I don't remember if I actually read it way back in the day, but talk about history and prescience and what's going on there. I mean, it's a fun, easy read, but there's a lot of stuff in there that makes the case that you just made there for history being important and remembering the past.
Yeah, things seem to come around in different cycles, right?
They do. Humans are habitual creatures.
So talk about this cycle. We started out a little bit. I asked you if this year in particular is different than any other year and it's unique. But this particular election cycle, is it different this time? Are there different scenarios, or how do you look at this election cycle?
They're always all different. It's the question is of how and to what degree, and that's always the case. That's always what we're looking at. That's where we overlay technicals and fundamentals and other observations. Zooming out a little bit, other than just this year, election year. If you think about the last 4 years, which this 4-year cycle, there's a chart that I've put out there that I checked, and I know we've talked about the sweet spot of the 4-year cycle, which is midterm year fourth quarter to the pre-election year first 2 quarters, which was the fourth quarter of 22 to the first 2 of 23. Market crushed it. We've been tracking this 4-year cycle, though people will tell you that the cycles don't work. We're way off. It's not. I don't see it matching. You got to use a little bit of imagination, just like all types of technical analysis, which cycle analysis is a form of technicals because you're looking at price over time. There's a little bit of art involved. And, anyone who tells you that investing is pure science and it works exactly the same way is nuts, because people are emotional creatures, and societies, perpetuate that or expand that. So you're looking at this cycle starting in 21 through the present that has been tracking that 4-year trend where, we see that midterm bear market low, which people, I don't know if you heard of what we were doing back then, but everyone was all bearish in October 22. Not me, not us. We got long, and that, sweet spot delivered. And here we are again, tracking that cycle. Even some of this sort of mid-July peak and some of the sideways action we've been seeing here since, we had that, tech peak in mid-July. And it's right on schedule. Not exactly the same. It's not perfect, but we're setting ourselves up for this end of Q3. Now it's quadruple witching. The week after quadruple witching is notoriously difficult. You've got the October volatility and October phobia. You're looking back at the 69 Almanac. My father was talking about, the bargain month, the bear killer, October, way back then. It still happens. It sits at this place in the calendar where the institutions that drive the market operate on a quarterly basis. It sits there right ahead of this really bullish time of the year where everyone's putting money in the market. And there's also this October 31st deadline for, mutual funds that they have to reconcile their accounting with the previous year's 10 months ending October, the current year's 10 months ending October, and then the annual, calendar year stuff. And they've got to distribute profits by October 31st and December 31st. So there's some IRS code requirements that also add to this churn and vol around this time of year, and additional to the general seasonal behaviors. People come back to work, back to school in September. They start cleaning house, restructuring portfolios, getting their, they want the statements looking good for the year end and the end of the quarter. And that's what causes this churn every year in September and October.
Has there been an election cycle where a changing monetary policy has kind of been in play, whether going up or going down, kind of like we're all watching it right now?
Nothing significant. I mean, you can think back to the Volcker years coming around the turn of the election there, but it wasn't quite happening right around the election as much. And the thing that I'm finding important or most relevant for this rate cutting cycle is what's going on in the market and what's going on in the economy and why the Fed's cutting and how much of a crisis mode they're in. They're not in crisis mode right now. This is not some sort of, we've got to either raise rates because inflation's out of control like it was a couple of years ago, or we've got to cut because the economy is crumbling. This is a very measured, calculated return. Take put a couple of cuts back in the chamber, and the amount of cuts. We did some studies on, if it's within a couple of percentage points or a couple 100 basis points, it's not going to impact the market and the economy as much as if you're doing a series of larger cuts or hikes that are really going to change the calculus and change the interest rate environment. So right now, the big discussion is a quarter of 50. Oh, Elizabeth Warren said 75. Okay, I'll bet a quarter.
Well, I think the market's just taking it good that we end up lowering rates, right? Just get that cut in. And I know the market's debating all different sizes of cuts. I mean, do you see that as beneficial to the stock market, or do you see it as kind of the stock market being indifferent, kind of just given where valuations have run to?
You mean lowering rates being beneficial?
Yeah.
It's not going to hurt.
True.
I mean, it's going to be beneficial. I'm being a little bit sarcastic there. The point I'm trying to make is that a little cut is good. If they have to cut a lot, something's wrong, and that will signal the market. I mean, you can see the bond market starting to lead the Fed here again, as it hasn't for a while, and the stock market is clearly showing that it's pleased with what's going on, whether it be in the economy or with what the Fed's doing or how they're handling it. So this will be beneficial. The uncertainty around it right now, and with the election coming up, will probably give us some more of that, maybe a little more softness in the stock market before we get our fourth quarter rally. But again, once we get a decision on the rate cuts, there'll be another meeting that they'll all be wondering about. Then once we get a decision on the election, we'll remove some uncertainty from the market, and we should be off to new highs again.
To party on, huh? All right. Keep it rolling. You've written in a recent blog that the August 24 pullback was more analogous to 1968 than 1987. And I thought that was an interesting point. And I wonder if you could kind of walk through that analysis and what you meant there.
A couple of things. Number one, 68's an election year. 87 was not. Two, 87 was up a whole lot more, on the S&P. I think it was a 20% first quarter versus 10% this quarter. We didn't have the type of environment we had. And then you had this similar type of Democratic convention in Chicago with the sitting president not running for re-election. The levels line up, with the magnitude or amplitude of the move, the election year, and the fact that it's tracking pattern more closely. And that 87 was just up so much more. And we've also got the circuit breakers in that 87 created. So they're not we can't have that kind of a year again, at least not that quickly, that rapidly, with the daily limits on the market.
Now, do you track valuations of some metric, and just kind of curious how that looks historically, if it means anything at this point, just in terms of where we are where the market is?
I mean, when I pick stocks, I look at valuations much more closely. When I look at valuations, you're talking about S&P earnings, multiples, that kind of stuff. Sure, but it's more of the future that's important. And the lower interest rates are, the higher the multiples can be. It's a little rich. It's not undervalued, the market, but I think it got ahead of itself with AI, and we've seen some of the big chip Supermicro, which is one of our stocks. We bought it at 81.93 back in November 22. So we're okay. We sold half on a double twice, or more than a double. So it's okay to see that down at 400 when you're in it at 82. So, but all those valuations, were a bit rich, and it come back to earth a bit. And we've seen some stocks getting hit today. Apple was down quite a bit earlier. People got a little too hyped up with this tech boom and this next technology cycle that we're in here.
So sitting here today and kind of looking forward, does that argue for maybe diversifying away from tech, or maybe not adding to your S&P exposure, but adding to some other sectors to be a little more tactical or focused?
I'm tactical by nature, so I'm tactical seasonally. I don't think you should diversify away from tech per se, but it depends upon your age and your risk-reward profile. There's plenty of reasons to be diversified in many different sectors. Right now, I'm sitting in a good chunk of cash and bonds during our worst 6-month period, and I still got the Qs. Yeah, sometimes it's not necessarily diversify away from tech and into, staples or defensive stocks. It's depends upon one's investment profile, whether you're, 30 or, 80 is going to make a difference. But diversification in general is a wise thing. I like to pick some smaller stocks that are off the radar, along with our sector rotations into different sectors, using the seasonal work as well. And small caps and big caps and mid caps, it should all be in there, unless you're, a professional fund manager and you're doing your own research and you're picking your own stocks. You should definitely be diversified. So, but I wouldn't diversify too much away from tech, because that's what's going on in the world these days.
It's definitely driving a lot of innovation and driving the world, like you say. And to your point, everybody's situation is different, so it kind of depends on what you're sitting on and how much you want to diversify and what kind of taxes you're dealing with. Are you trading individual stocks, or are you looking at kind of broader asset classes, indexes, generally?
Both.
Okay.
We have 3 main portfolios that we produce in our newsletter that I follow myself. One is the tactical, seasonal switching strategy, the best and worst months. Everyone likes to say sell in May and go away. I say buy in October and get your portfolio sober. We just trade the ETFs there. We look for a new buy signal coming into October, which is the last month of the worst months. MACD trigger we look for there, a technical trigger. And we get into the DIA, the SPY, the QQQ, and the IWM. And then we have a sector rotation portfolio, which similar seasonal influence, but sector by sector. And, it doesn't take a genius to figure out that in October is when the bulk of the stock sectors hit their, seasonally bullish period. We do have a few short sectors that we'll trade. We'll rotate, sectors using some seasonal and fundamental, overlays on there as well. And then for the stocks, we have, a small cap, mid cap, and large cap portfolio. Small for us is under $1 billion. Large is over $5 billion. Mid's in between there. And we run a robust fundamental screen looking for stocks that are exhibiting an acceleration of growth in revenue and earnings, have good valuations based upon not just earnings, but price to sales and margins and debt, cash flows. And we're going to do that at the seasonally opportune time of the year after we get our buy signal in October usually. And we do a full screen with all of our fundamentals. We're also looking for stocks that are underfollowed, have only a few analysts tracking it. And we'll look at, comparisons to the market. We want relative strength to be right about where the market is. We don't want to lag in the market or leading the market. We're looking for valuations around, the major averages are, just so we benchmark it to where the rest of the market is. And we find some pretty cool stocks in there that, end up becoming the biggest stock in the Russell 2000 and other things like that. So,
do you think small cap stocks will run again? I mean, I feel like relative to large cap stocks, it's been a tough go longer term.
Individual stock by stock, you're going to find some great opportunities there. You're going to have to manage that by getting rid of stuff that doesn't work. You're going to have to honor your stop losses, cut losers short. I mean, the key to investing is let your winners run and cut your losers short. Small stocks are still struggling with the interest rate situation, and I think the globalization of the world makes it a little bit hard for small stocks to operate a little domestically. But there's also a seasonal trade there, and small stocks do very well from November through January. Something used to be called the January effect, not to be confused with the January barometer, which is what Yale invented, the indicator that as January goes, so goes the year. But small caps used to outperform large caps in January. And what we've seen over the years, the last, 20, 30, 40, 50 years, is that that shifts to the last couple of weeks of December. And there's a chart we have in the almanac where we have the Russell 1000 versus the 2000. And right around Halloween, it starts to bottom out. And then, you see it take off from around Thanksgiving through mid-January. We call it the small cap effect. There was a big pop here earlier in the summer when the market was pretty confident that we were going to get a rate cut. Small caps got excited, but they've come back to earth a bit. Again, if you're not just going to trade the Russell 2000 or some other index, you got to be selective with your picks, and that's one of the things that we do in the newsletter.
Are there spots in the current market that you find particularly attractive, whether because it's seasonality or just oversold or whatever?
Biotech is coming into play here. One of the ones I'm looking to get into. Bitcoin is coming into its seasonal low. I'd like to see it a little bit lower myself. I'm being patient. I'm waiting there.
How many seasons of Bitcoin have there been? I still think it's a fairly young asset class, isn't it?
Agreed. I was skeptical, and the seasonal pattern that I look at only starts in 2018, really, which is the first full year after the CME futures started trading. And I think before then, it was just too crazy, too volatile, too Wild West to really have anything to find. So that seems to be the seasonal pattern that's strongest for me, going back to only 2018. So pretty much buy in September. It really tracks the stock market now, NASDAQ especially. There's a few other things going on out there, but it's kind of like 4x the NASDAQ with the moves that it makes. So that's something that you could trade. But I think I traded it about early October to January last year. Left a little bit on the table, but it was a pretty solid move. So, don't be too greedy.
Yeah, that's a good point. When you look at your data and your charts and everything that you look at, and you look back at history and past cycles and seasonality, it sounds like it has a strong influence in terms of when you do things. But do you ever gut check yourself? Do you ever go, yeah, things look a little different? I mean, vastly different or look a little different or whatever it is, and ever second guess yourself or your data?
I think gut check's a better word than second guess. I've found that anytime I second guess the research that we've done, it works against you. We're going to miss a few trades, but who doesn't miss a few? You're not going to, be there to the top or get in at the bottom. But, over time, this overlay of seasonality, I mean, as I'm trying to convey, it's not just seasonality, Russ. I mean, that's our top discipline, but fundamentals, technicals, monetary policy and sentiment. Sentiment, I look at the Investors Intelligence survey a lot, and people look at AAII and others. Investors Intelligence has been around for a while, and it's a survey of people that actually get paid to do what they do. So it's not just anybody's opinion. It's somebody who's has to have been around for a while because this is their business. When that gets really negative, it's been a great buy, like October 22. And also when it gets really, frothy, it's also a time when stocks usually back off a bit as they did in after mid-July. So there's some built-in gut checks, Ed, with fundamentals, technicals, sentiment on top of the seasonality, and then just general experience. It's not automatic. You have to think about it, but you want to keep the emotions out as much as possible.
I wanted to get your take on gold. What do you make of gold's ascent this year?
Yeah. I think there's a couple of things going on there. I think there's some central bank buying, and there's some, I don't think it's as much of an inflation hedge as it is, but there's a lot of uncertainty in the world and the global turmoil that we're dealing with, whether it be in Europe, in the Far East or the Mid East. Without naming names, we all know what we're talking about. I think that is having an effect on people flocking to some gold. It's also, an industrial metal. It's in quite a bullish, technical uptrend market. I mean, it's just, you can't deny it. So it's probably not over, but we're also coming into a seasonal period for gold here. It's definitely a part of the program for sure.
How does it play against, like, with global growth and maybe other commodities? Are you seeing support for other commodities, or is that kind of weak currently?
We're not seeing so much support for oil right now. There seems to be a little bit of a pullback there. We'll likely set up the seasonal trade there, which begins around December. There's a commodity cycle in play here. There's no denying that. It's a little bit more individual by the commodity. You can see with what's going on with natural gas and oil versus gold. The seasonals definitely can help, but you have to look at the macro trend as well. And right now, the only one we're really working for us right now is the gold seasonally and the macro trend there as well. But we're looking to get back into oil and gas December, February, when that seasonal bottom tends to occur.
That's interesting. I didn't realize the seasonality part of that. And you may have addressed this in past questions, but let me ask it this way: what's in store for 2025 after the election?
Well, everyone's got this, from some of the work we've done, this thought in their head, this idea in their head that post-election years, the year after the presidential election, is the worst year of the 4-year cycle. Well, not since 1985. It's something that, we're already kind of bullish on for next year. I don't see this particular cycle ending, this bull cycle ending anytime soon. Midterm years have been that worst year. I think that's where we're going to see our weakness. We might end up topping out a little bit next year, but so far, depending upon who's in office, and I don't mean who as in the person or the individual, but what parties are controlling which branches. Democratic president, Republican Congress is the best combination for the stock market, or has been. Post-election years are better for Democrats. They tend to take more time getting things implemented, whereas Republicans tend to, know what they want to do right away and go in and start changing things in the beginning. So, but in general, the post-election year has been the best year of the 4-year cycle, going back to 85. Not a long period of time, but there's been some pretty strong years there. 21 was a case in point of that. I'm not bearish for 2025 at this point.
Now, maybe you could talk a little bit about your business, because I think you probably help investors do that and guide them through it a little bit.
Yeah, it's stocktradersalmanac.com. We have our Almanac investor newsletter, and we guide people through a lot of what I'm talking to you about right here. And when we put out recommendations on buying stocks and ETFs, it's not just what to buy, but when, what price, where to put your buy limit, where to put a stop loss. We do some trading, but it's not in and out trading. It's more swing and longer swing type trading, where it's, periods that last months or at least weeks. And we put it out an issue every week. We usually do ETFs the first week of the month, stocks the second week. We'll do our monthly almanac about what to look for seasonally and holiday trading and, the different personality of any given month. And then we'll do our monthly outlook. And that's where we get into 5 disciplines, fundamental, technical, seasonal, sentiment, macro, and whatever different things are going on this month. It's about September, October, and how they behave in election years and rate cuts. And then we'll have a members only webinar the week after that, where we'll, present some slides and then just really open the floor up to questions and get into whatever our members are interested in knowing about, or drill down at some of the details of what we're doing in case things need to be clarified, if there's other areas that they're wondering about.
What's, as we start to kind of finish off, I'm kind of curious, and I may have asked you this before 4 years ago, but I wonder now, what's one long-term trend you see playing out over the next year or several years? It could be market related, it could be thematic, it could be anything.
I mean, the long-term trend is this super boom that is the subject of a book and a forecast. There's the super boom equation is inflation, which we've finally dealt with here. It came a little later in the cycle this time around. Political functionality, which, would help maybe if we had a proper Republican-controlled Congress and Democratic-controlled White House, they could actually agree on something separately. They come together and compromise. We'll get some of that. And then there's the, technology part of the equation, what I call a culturally enabling paradigm shifting technology, which I believe, like the microprocessor or the internet or the internal combustion engine or whatever you want to, go back in history and pick up. I think AI is that technology.
It's the start of a new revolution.
It is. And as I mentioned earlier, I think we're in those, early middle innings around the Windows 95 period, if you want to think about it, which came out of the microprocessor and the programmable language and, all that stuff that came out, when we had the last super boom that took off in 82, after the double dip recession. I think that is the big macro trend here. And I think the market's got a lot further to go. There will be another cyclical bear market at some point. I don't know exactly when, but if I were to have to venture a guess right now, it would probably be in 2026, the midterm year. Maybe we'll get some little recession, maybe not. You can have a bear market without a recession. The economy's still quite strong. There's some weak spots around the world, but for all intents and purposes, I think the secular bull market, the long bull market, continues on for quite a few more years. Might get a little, 20, 30% bear here or there. I mean, we were down, 14 or 15% on NASDAQ from the July peak. That kind of pullback is not hard to fathom.
Yeah. So would you look at those pullbacks as buying opportunities then? It sounds like you might, just kind of given your longer term view.
If it lines up with my seasonalities, yeah. The last August one, I didn't think was a great buying opportunity yet. I think if we get another one of those, or if I think we can test those lows again somewhere in the coming weeks. That'll be the better buying opportunity.
How about a little trend or fad?
Sure, let's do it.
All right, nuclear power, trend or fad?
Oh, I wish it was a trend. We really could use it.
Yeah, we're getting a lot of questions about that. I think maybe because of AI and the AI power need, maybe it's bubbling up on people's radar.
It should be. It's so much safer now because all the plants are much smaller. So I don't think it's a fad, but it's not a trend right now. It needs to be.
Founder mode, trend or fad?
What's founder mode?
It's a term for founder-led companies where they're founder mode and they're hands-on in everything to control their companies. There's like a debate whether that's good or bad to go into founder mode.
I think it's inevitable. Nothing great has been created by a committee. Most of these great inventions, these great companies were driven by one person who had a vision. So it's not a trend or a fad. It's a trend, and it's going to stay that way forever because that's what makes the world go round.
All right. How about India, trend or fad?
Trending. They've got some issues. I have a friend who lives over there, but yeah, especially with what's going on with China and Russia, I think that they got to fix up some stuff, as we all do, but I think it's trending.
And then finally, cassette tapes, trend or fad?
Is that coming back?
Yeah. There's a Wall Street Journal article about that. Yeah, it's like Gen Z finds cassette tapes.
I don't know if my old tapes will work anymore, though.
I wonder. I don't know if I even have a cassette player, but yeah, apparently, according to this article, Dua Lipa and Ariana Grande released their new albums on cassette.
Well, I don't think it's got a trend because, vinyl's come back a little bit. We have some records. I used to have a whole bunch. They lost in a flood. But, it's kind of a fad that's going to stick around. It's just sort of like something unique to do. I don't know if it's a big trend that they're going to start making money. It's just something cool.
Once you have to untangle that tape from your tape player, you're going to say, forget it. Let's go back to MP3s.
You got to put a number 2 pencil in there, right?
Yeah, turn it around. Yeah, or something. I forgot how to do it now, but thank God those days are over. Jeff, this is awesome. Thank you very much for your time and insight.
Appreciate you guys having me.
Yeah, thanks for coming on again. And we'll do it sooner next time around. And Jeff, before we take off, what's the best way for people to learn more about you, Stock Traders Almanac? Where can they find you?
On the internet at stocktradersalmanac.com. My handle on Twitter and Insta is Almanac Trader. I'm on LinkedIn as well, but that's all pretty much at stocktradersalmanac.com. Or just Google it.
With that, thank you for tuning in to another episode of Trends with Benefits. I can't believe I almost forgot the name of the podcast right there. But thank you again. Talk to you later.